I'm Jim Cramer, and welcome to my world.
You need to get in the game.
Firms are going to go out of business, and he's nuts. They're nuts. They know nothing.
I always like to say there's a bull market somewhere, and I promise
Mad money. You can't afford to miss it.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends, trying to save you a little money. My job is not just to entertain you, but to educate you, so call me at 1-800-743-CNBC. Just because the story is big news, that doesn't necessarily mean it's important big news to the stock market. Yet on any given day, like today where the Dow surged 73 points, S&P gained 0.68%, NASDAQ rose 0.95%, it feels like we want to commingle so much news with the market that it's enough to make your head spin. Just today, I heard many people tell me that this market must trade on the budget submitted by President Obama. I heard that this document, which includes some pretty serious tax increases for the wealthy, including potential doubling of the tax on dividends, should be the centerpiece of what happens next in the stock market. And that means, of course, that the stock market should head lower. At the same time, I heard the debate about the trillion-dollar deficits and how hard it'll be for the United States. That should be the controlling factor. That should be the be-all and end-all of stocks. I mean, what happens if the deficit goes from out of control to totally apocalyptic? Don't we have to sell stocks now, just on that specter?
Sell, 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 sell.
Then, of course, I heard the obligatory chatter about the need to sell all stocks because of the European dominoes. Greece defaulting, triggering an unruly collapse. You always hear that word, unruly. That would bring down Portugal, maybe Ireland, and therefore create a shock to the system that could send us into a 2008-style global tailspin. Meanwhile, I was hearing that if we allow the Bush tax cuts to expire at the same time as we cut more than $1 trillion in spending, it could trigger a brand new recession here, one that could happen easily because of the fragile nature of the recovery. You want to be in stocks out 6 months if that happens? Of course, the debate over Obamacare and the Catholic Charities only called into question exactly how meaningful Obamacare will be and how much it will cost employers beginning next year, and how the economy can't afford such a body blow because it makes hiring more costly. Hey, by the way, that is something I believe to be true. Oh, and with Israeli embassies being targeted by some sinister force, coupled with the ticking time bomb that is Iran's nuclear program, how could you want to own stocks ahead of a potential war between Iran and Israel? Do you really want to be in the S&P, knowing that this exogenous event looms on the horizon? You want to own stocks with gasoline at $8, courtesy of Iran blockading the Straits of Hormuz? Look, okay, these are all cogent reasons to sell the market. That's right. If you only view the stock market as a single asset class versus, say, the asset class of bonds, the asset class of gold or real estate, and you consider all these painful choices and how it could pretty much derail anything good. So I understand why you would want to go into cash tomorrow. In fact, I heard a guest on CNBC say it's time for a risk-off approach to the market because of all these problems and a few others I didn't even catch. To which I say, thanks for nothing. That risk-on, risk-off nonsense is so 2011. When the hedge funds and high-frequency traders and the brokerage house prop desks ruled the roost. The whole nomenclature of risk-on, risk-off is a false one. It is purely bogus. It is bogus. Something that a bunch of quants must have said on trading desks that then somehow seeped into the media parlance by people who wanted to sound cool, by people who wanted to sound like they knew how the professionals talk. Me, it means nothing to me. And if it means nothing to me after 32 years of running money, then it should mean nothing to you, too. So what is the real issue? How do we integrate the parade of horribles into our thinking? You know what? It depends. It depends on the stocks. Individual stocks that might or might not be affected and impacted by these exogenous events. Until the last few years, I can tell you that the only times I really cared about so-called macro news could be counted pretty much on one hand. That's right. As I like to say on the trading desk, what does the budget deficit have to do with the price-to-earnings multiple of Bristol-Myers? In other words, these bearish news stories should have more of an impact, cerebrally, right, than they actually do. They should seep into our consciousness and make us more nervous, but they don't. But it's just not what happens. Instead, for many stocks, the news doesn't register. These stories don't influence the price of Apple. They don't impact Verizon or AT&T. They can't seem to be matched against Pfizer or be calculated into the last sale of Microsoft or even the closing prices of red-hot stocks like Cummins or Caterpillar. Am I saying these big-picture negatives mean nothing? No, I'm not stupid or glib like that. As I told you last week, I want to see what the Germans do with the deal the Greeks arrived at this weekend. A disorderly default it's another one, unruly, disorderly. A disorderly default in Greece would be very negative for stocks. Why? Because we'd have to figure out what happens to the euro in that breakdown, as the euro deeply impacts the actual earnings of companies, as we know from all the conference calls we've just gone through. As I've said over and over, if earnings go down, if estimates get cut, stocks do go lower. But the bigger issue right now is what happens if Germany embraces Greece and at the same time China cuts interest rates. Next thing you know, you got yourself a monster rally while you're sitting there worried about the budget deficit. All right, let's take the budget deficit. It's real. If we're being serious, if we really believe a balanced budget is important, then both entitlements have to be cut and taxes have to go up. It's true, but a lot of parties won't agree to that. But here's the thing. Right now, interest rates remain so low that the competition for bonds for stocks is almost non-existent. Hey, look, when the treasuries used to yield 7 to 8%, those were rocky time for stocks because the competition was pretty darn fierce. Treasuries yielding 3%, please. Until rates move up and move up dramatically, which could indeed happen in a couple of years when the bond vigilantes are done wrecking Europe, they don't represent much in the way of competition to stocks right now. It's just not palatable to own bonds versus owning higher-yielding stocks. Even if Obama is able to raise taxes big on dividend income as he proposed today, and remember, I don't think that'll get passed. Gasoline at $8. Terrible. Just terrible. But this market is not going to worry about Israel attacking Iran until Israel attacks Iran. Why not? Because if Israel doesn't attack, fund managers feel they will miss out on more of this magnificent rally, and they'll fall even further behind those who are much less worried. In other words, the guy less worried about this stuff is making a lot more money than the guy who's more worried about this stuff. Why don't you file it under, I will stay long with a nice cash position until I get whacked by exogenous events. And if I am, I will then buy more stock because so many of my companies are doing so well, and yet stocks are still historically cheap, including many of my favorites. That's the mind of the winning fund manager right now. Here's the bottom line. We aren't whistling past the graveyard here. We're simply not at the juncture where bonds represent serious competition to stocks yet, or we haven't seen the bad news yet on the tape. And until we do, we can't figure out how these potential negatives factor into the stocks we like. Look, I know it's our job to predict what will happen to stocks if certain events do occur. We don't know what the future will bring, but we do know the correlation is now to individual stocks, not the entire asset class. And we look at these individual stocks, we can't fathom or see the impact on many of the stocks we like from these events. Selling Darden. Let's say we can't sell Darden right now because we think Red Lobster will be hurt by higher gasoline prices if Iran blocks the Straits of Hormuz. We can't sell Wells Fargo off of Greece. Wells doesn't have any European exposure. And selling Bristol Myers with its 4.2% yield and strong earnings momentum simply because of the budget deficit? Enough already. That's just plain nuts. Let's go to Ron in New Jersey, please. Ron.
All right, Big Barney, get booyah to you.
Nice
Jim.
local booyah back at you. What's up?
I'm new to the stock market. I invested in Ram Energy. They had purchase agreement with Halcon Resources, HK, 3-to-1 reverse stock split. How should I play by the bay? Should I go fishing or bail?
No. I like that. And you've got some great bloodlines here in this company, too. Guys who have been real winners. No, I want you to stay on it. And I think, I think that Ram was a very valuable company. That guy had built companies before. I think you're in good shape owning that. I want you to hold on, okay? Let me see, just so we know, this was the old, see, they changed the symbol. It used to be Petrohawk. Remember, they sold that? I mean, it used to be HK. I forget exactly which one. I don't want to say that. But I know that HK is back, and this version of it looks pretty darn good. HK, yeah, this is now Halcon Resources. Okay, let's go to Frank in New York, please. Frank.
Booyah, Jim.
Booyah, Frank, what's up?
I'd like to know what's your opinion on Capital One if the Fed does approve of its deal with ING.
Oh, if they do that, I happen to have loved ING's business. You know, ING got in a jam, but that online business was just, the ING direct business is so fabulous. This would be fantastic for Capital One. As it is, Capital One is a pretty darn good company right now, but that would make it so it gets a premium multiple over all other bank tech stocks, except for Visa and MasterCard. That's why I just throw in tech. All right, we can't predict the future, but we can't be captive to it either. So how do we react to the uncertainty? Hey, sorry. It's no longer how the stock market reacts. It's individual stocks, and many of them will react positively or not react at all. Mad Money, be right back.